This is the global sovereign debt bubble, the everything bubble. What just happened in Japan took a lot of us by alarm, and we now think that the clock has been set for the global unwind of the debt, and it's going to, in conjunction with a weakening U.S. economy. I'm predicting it just the clock started. We think it's going to manifest over the next 24 months. And our economic indicators started rolling over again in March. They've gone down every month since March. And then here we are going into the most controversial election ever, and something broke. China's economy is imploding, and it's very, very bad there. So they need to, one of the greatest fears the Chinese power elite have is their own people. So the classic tactic is when all else fails, take them to war. The time frame between crises is getting shorter, and we need to keep accelerating the debt growth even faster. So that's why it's getting very precarious. Every time they do something, it buys less time to fix the system. So this is a very dangerous time. I believe liquidity is a big problem in the global financial markets, and as that becomes more apparent, we'll see more financial turmoil. We're going to see bank consolidation resume, and my prediction still holds. There'll eventually be 6 banks, or 8 to 6 banks, and that's when it would be easier to introduce a central bank digital currency. Warren Buffett is not in cash for a 20% pullback. That's not what he does. He's in cash because he's going to take advantage of what happens when this unravels. And my guess is you don't hold that amount of cash if you're Warren unless you think a big financial crisis is coming. What I can tell you with great confidence is we're going to have financial havoc and turmoil coming soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori. Thank you again for joining us. With the interest rates at the highest level in 23 years for over a year now, markets have been bracing for the economic impact of that strain, for the Fed to break something. My next guest says that the Fed did indeed break something, and that was another central bank. The Fed broke the Bank of Japan, and now the clock has started counting down towards a global debt crisis. Here to explain this and more and give us his outlook on the markets, gold and Bitcoin is Edward Dowd. Ed is the founding partner of Phinance Technologies. He's over 3 decades of experience in finance, including working as a portfolio manager at BlackRock, the world's biggest asset manager. He's also the author of Cause Unknown. Ed, nice to have you back with us. Thanks for joining us again.
Michelle, great to be here. Thanks for having me on again.
Ed, very good to have you back with us. Before we get into where we are now with the Fed and the Bank of Japan and interest rates, I want to pick up where we left off last time. And you were on in late March of 2023. We just had 3 of the 4 largest bank failures in US history were in the midst of the banking crisis. And you were expecting an emergency rate cut by July from the Fed following those banking collapses. Now, instead, we got the Bank Term Funding Program and other creative solutions, but there was no rate cut. In fact, the Fed hiked rates. There were 3 more 25 basis point hikes after that, with rates peaking at the 5.25% to 5.5% range about a year ago, and the Fed has held steady since. So let's begin with what happened there, why you weren't correct, why didn't that rate cut happen, in your opinion?
Yes, Michelle, we did have a misstep in our prediction. We were wrong on the interest rate cuts. They, in fact, raised a few more times. The good news is they prevented a bank run. The Federal Reserve instituted the Bank Term Funding Program because the assets in their held-to-maturity account were way underwater, and people were starting to get nervous, and that's why we had those bank failures. So what the Fed did is lent the banking system short-term loans to prevent these bank runs, and they unfortunately took away those loans in March 11th of this year. They ended the program, and at the time that we made the call, the credit markets hadn't yet deteriorated. Now we are in the part of the economic cycle where credit is deteriorating, and the Fed is not going to give loans against bad credit on the bank books. So that's one thing we were wrong on. The other thing we were wrong on, we were calling for a recession in Q3 and Q4 of last year. our economic cycle indicators, which is our proprietary black box leading indicators, showed a recession coming in that time frame. And what happened in October, along with the Federal Reserve's Bank Term Funding Program, the government went on a spend. Seeing the deficit explode, they juiced the economy and they created government jobs. At the same time, they were also manufacturing payroll numbers. It's been well documented that the payroll numbers have been revised down after every month to the tune of 1.5 million jobs. So, and Jerome Powell recently even stated the payroll numbers are in question. 2 meetings ago, he indicated that there's some question about that. So what we did get in our economic indicators starting in October was a bounce. And we saw our economic indicators bounce. But what's important to understand is they bounced and never got above the zero line, which is expansion. So whatever the juice that the government did and the Fed fixed, it kind of didn't get us into expansion. It kind of delayed the recession, so to speak. And our economic indicators started rolling over again in March. They've gone down every month since March. And then here we are going into the most controversial election ever, and something broke. And our expectations before the Bank of Japan crisis was that we were going to see a little correction into the election, then a rally out of the election, and as the economy continued to weaken, we would see the real problems emerge. What just happened in Japan took a lot of us by alarm, and we now think that the clock has been set for the global unwind of the debt, and it's going to, in conjunction with a weakening U.S. economy. So what we don't know are what the policy responses are going to be on the other side of this, which are coming and have to come. One more thing, as soon as the markets blew up last week or into this week, the expectations quickly went to emergency rate cuts. The Federal Reserve came out on Monday and indicated they're waiting for more data. The Fed is loath to lower interest rates, primarily because once the global financial markets catch wind of the Fed lowering interest rates and ending the rate hike pause, and we'll see a big correction in risk assets, which they want to avoid.
Right. So it comes a point where bad news is actually bad news, right? That when the Fed is forced to cut, then the markets start to interpret that as a sign that things are really not going as well as they would appear. You mentioned that we had basically just new artificial, unprecedented ways of stimulus, new Band-aids put on the economy, be it the bank funding program or other ways that sort of just kept things, or changing the data or manipulating the data or getting the data incorrect, depending on your interpretation there, that sort of kept things afloat for a little bit longer. I really want to unpack the whole Fed breaking the Bank of Japan. But before we do that and get into detail there, where are we now in terms of what you think the Fed is going to do?
So the interest rate markets quickly predicted emergency Fed rate cuts. I, of course, pay attention to that, but I also wanted to hear what the Fed had to say. They came out on Monday. Bowlesby, the Chicago Fed president, basically came out and said this. One bad payroll number is just one bad payroll number. That happened on Friday. We need more data. If we see the economy weakening, we'll act, which was, to me, messaging that the Fed is on hold and not going to do any emergency rate cuts unless the feedback loops are so bad from what just happened in Japan that the stock markets and the financial markets start to crater. Absent that, the Fed is doing nothing until September.
Right. And we did get some positive data with jobless claims looking better than expected. That sort of helped the markets rebound in the short term since that Monday sell-off. Again, we're going to get into that a little bit more. So let's get into this idea that you said the Fed essentially broke the Bank of Japan. Explain what you mean by that, and perhaps start by giving us the background of Japan's economy and the demographics and why it had rates so low for so long.
Yes, so Japan is one of the major central banks that have been coordinating easy money for the last 14 years since the Great Financial Crisis. It's the Federal Reserve, the ECB, and Bank of Japan. These are the three, and they've been passing off the baton of injecting liquidity into the global system. And when I say injecting liquidity, injecting debt, because debt is money. you create a credit, you inject liquidity into the system. So they've been one of the three legs of the stool, and they've been keeping their interest rates essentially at zero for decades because they had a demographic problem and a bubble burst in the late 90s. So what happened with the Federal Reserve hiking interest rates very quickly to 5.5% caused the Bank of Japan's currency to weaken because they did not raise rates along with the Federal Reserve. And this interest rate differential caused the currency to implode in Japan. And several weeks ago, it got as high as 161 US dollar to Japanese yen, which is levels we hadn't seen since the 90s. So the Bank of Japan has 260% debt to GDP and a huge demographic problem. Some of our demographic work shows that they just hit a new acceleration phase in a demographic death spiral that's going to bottom sometime in 2030, 32. So they are in trouble. And it's been one of my theories, and a lot of people on Wall Street, that the global debt bubble, the release valve eventually will be a currency crisis somewhere. And this just occurred in the Bank of Japan. So now they have this Hobbesian choice of saving their own economy or saving the global financial system. And this is where we are. So this is kind of the beginning of the unwind. There'll be policy responses. It can happen slow or fast. Right now, I'm predicting it's just the clock started. We think it's going to manifest over the next 24 months. We do think the U.S. economy is weakening, and this is a bad, toxic brew that suggests risk assets are something you want to be lightening up on in your portfolio over the, if you haven't already done it, you should go down rallies.
Well, we did have the Bank of Japan walking back talk of further rate increases after roiling the markets. One of the senior bankers there promised not to raise rates when markets are unstable. This was the Bank of Japan Deputy Governor Uchida. And that, of course, led to a sharp recovery in the Tokyo stock prices and a fall in the yen. And as we mentioned, the markets were really roiled by that surprise decision to raise rates for decades. And of course, that then impacted the so-called yen carry trade. Help our viewers understand what that is and why that initially caused the sell-off in global risk assets, and whether you think this yen carry trade is fully unwound now.
JP Morgan came out today and said they think 75% of the yen carry trade is unwound. That's probably fiction, in my humble opinion. Yen carry trade has been going on for decades. You could make the argument that the Japanese financial system is one giant yen carry trade. So the yen carry trade, for your viewers who don't understand it, is because of the interest rate policy in Japan for decades, you would borrow in yen, and then you would buy assets in other countries, in other currencies, and you could lever that many, many times to collect the spread. That trade blew up after decades of being used by many, many big pocketed players, large institutions. I would say that the Japanese financial institutions are probably the biggest owner of that trade. They borrow in their own currency and then go buy assets abroad, not making loans to the Japanese economy because they have a demographic deflation going on there. So that's the situation. We have trillions of dollars in assets that are levered, and the trade is going the wrong way. So it kind of creates a giant margin call. The good news is the Bank of Japan came out and said they're not going to raise again. The problem is, if you look at their currency, it went from 161 to 142, which, by the way, when currencies move like that, that just creates turmoil in and of itself. It's now rising again. It's approaching 148. So if they continue to play along and not raise rates, they'll have another currency crisis on their hands. So they're caught between a rock and a hard place. And again, that's why I think this will be slower rather than faster. But I think the bell just got rung, and it's the beginning of financial turmoil and heightened volatility, especially going into this most recent U.S. election that's coming up. There'll be a giant pause in business decisions until we figure out who's going to be sitting in the White House seat. So there's just a lot of uncertainty going on right now across the globe, not to mention the global military conflicts, the Ukraine war, tensions in the Middle East, and then there's always the possibility that China, which has a demographic problem itself, they hit their wall in 2020. That was because of the one-child policy they had had for 20 years. So basically, China's economy is imploding, and it's very, very bad there. So they need to, one of the greatest fears the Chinese power elite have is their own people. So the classic tactic is when all else fails, take them to war. So that's why we've been seeing a lot of these Chinese, Taiwanese, threats going on. Warren Buffett himself sold out of Taiwan semiconductor stock. He listed war in Taiwan with China as one of the reasons he sold his stock. So this is not fanciful talk. This is a real problem that could explode and ignite at any moment.
Wow. Okay. Let's focus on the geopolitics and then go back to the Bank of Japan here, because you've just said some very interesting things. Warren Buffett, we know, is sitting in a lot of cash at the moment. I believe he's got more T-bills than the Fed right now. So you're expecting or forecasting China to move into Taiwan during this period of time now?
I'm not forecasting that. It's a real possibility given what's going on in China. And Warren Buffett himself, when he sold out of his Taiwan semiconductor position, said that in an interview. You can Google it. War was one of the considerations. So I would say Warren Buffett's more in the know than I am. So I'm speculating here. It's definitely a possibility. We do have tensions in the Middle East. We have tensions in Ukraine. And right now there's talk of Israel and Iran getting into it. And China, I believe, has said that they will back Iran if that happens. So there's a lot of hot spots that could go off at any moment that could add to the current uncertainty we're seeing. But make no mistake, without even the global tensions, we have problems. We have problems with the debt bubble starting to unwind.
Right. And we've had several guests on the show saying that if you were, let's call it a nefarious actor on the world stage, nefarious in the eyes of the US, if ever you were going to take action, now is a really good time to do this, especially as things move closer towards an election which is unprecedented in so many ways, including weaponizing of the justice system, assassination attempts on leading candidates, switching out candidates with a few months to go before the election, and we're still not even 100% convinced what the Democratic ticket is. So with all of the uncertainty and division and toxicity in the US, a lot of people have come on this show and said, if you were China, now is your time to move into the South China Sea or take on Taiwan. If you're Iran, this is a good time to potentially escalate things before you have a President Trump in power, which may take a stronger stance against actions in the Middle East and elsewhere. Russia, Ukraine, if you wanted to resolve that one way or another, this is probably the window to do that. So I agree. No shortage of geopolitical potential flashpoints that could explode at any minute. But if you were to hedge that, I know you're saying it's a possibility. We all recognize that it's a possibility. But how high do you rank that as the thing that is the Black Swan event that sort of triggers a massive crisis here?
Well, let's be clear. What happened in Japan last week was a Black Swan event. That's one Black Swan that just went off, and we're going to see the ripple effects for over the next months, years to come. So that was dropping a boulder in a pond, and we're rippling out. We don't know what the knock-on effects are. What's interesting about Japan is, typically speaking, they basically had a market crash, an 87 type crash. Banks went down 30%. Their market imploded. And we haven't heard of any brokerage firms in trouble that went bankrupt. During the 87 crash, they went bankrupt. So there's a lot of settlement issues that have not been cleared yet. We don't know who's holding the old maid in Japan, what bank. So, and in this most recent rally in the NASDAQ, the bank stocks did not really participate in it. So the knock-on effects are just beginning. So that's Black Swan event number one. Black Swan event number two is what you just said, potential escalation or hotspot or a new hotspot. If I had to give a probability of that occurring before the election, I would peg it at 30%.
That's pretty high. 30% is a pretty high probability of considering the chaos that could unleash. Okay, so these are potential events that could still happen and worse. And let's go back to the event that did happen. and see where we are with that. So how exactly was it that the Fed is to blame for the Bank of Japan being forced to raise its interest rates? What's the relationship there?
Well, so every rate hike cycle and every rate lowering cycle, so when they lower rates, they create a credit bubble. We created the dot-com bubble, then they reinflated and created the real estate bubble. Now, 14 years later, this is the global sovereign debt bubble, the everything bubble. And finally, the Fed raised interest rates after 14 years of keeping it near zero. And in all interest rate hikes, they break something, and it's not that they do it on purpose. Something just breaks because in these bubbles, excesses and frauds occur that then get unwound, and we see who's swimming naked, and there's knock-on daisy chain effects, and there's a lot of financial panic and turmoil. So the Fed didn't purposefully wreck Japan. It's just a consequence of them raising interest rates to 5.5%. Eventually, Japan, the release valve was the currency, and Japan finally had to raise rates. Japan didn't want to, but their currency forced them to, and this goes back to how this global debt Ponzi scheme works. It needs constant credit creation, constant debt flow, and new money, and eventually, when the debt gets too big, it's like a Game of Thrones. You're going to have a currency crisis, and this just appeared in Japan.
So, what does it mean? How does this trigger them? This potential debt crisis? How do you see it playing out?
Well, so what just happened was a massive deleveraging of the yen carry trade. People went bankrupt. We haven't found out who went bankrupt yet. We're going to then get a contraction in liquidity for two reasons. One, what just happened in the markets. Two, the weakening U.S. economy. So credit is contracting. The lifeblood of financial markets is liquidity, and that's contracting as we speak. You got to remember, M2 went negative year-over-year growth in November of 2022. And that set off bank failures in March very quickly. That even shocked me. And so the full effects of M2 going negative, there's always a delay in monetary policy. So the Fed hiked, M2 went negative at the end of 22. 18 months later is usually when the policy lag starts to take its real effect. That was May of this year. So this is a very dangerous time. I believe liquidity is a big problem in the global financial markets. And as that becomes more apparent, we'll see more financial turmoil.
All right. So, Ed, last time you were here speaking of the banking crisis, you did expect a consolidation of the banking sector as we would be seeing more and more bank failures. And ultimately, you said we'd land up with around 6 banks in the United States, which would then pave the way for a central bank digital currency, a CBDC, to be issued. That crisis, fewer banks, potentially UBI, universal basic income, in a really bad recession sort of facilitates the way to a CBDC being issued. And we sort of unpacked the horrors of the dystopian future that a CBDC could lead to. Before we get into the CBDC part of the conversation, what's your outlook now? What's your read on the banking sector as it stands?
So the good news, when I was on your show last time, I said this happens one of two ways: fast or slowly. The Fed was able to patch over the duration problem that the banks had, meaning their portfolios were upside down with a duration mismatch. What they're not going to patch up is a credit problem. We're now in the credit problem of the cycle, and banks' loans are going to start to go sour, and they're going to have to report those losses. So the Fed did a good job in delaying the banking crisis. So hats off to them. We'd rather see this unfold slowly than fast. When it happens fast, it creates chaos, and even the powers that be lose control. So I'd rather see a slow unwind rather than a fast unwind. And I expect as the economy continues to weaken, we enter into a recession, we're going to see bank consolidation resume. And my prediction still holds. There'll eventually be 6 banks, or 8 to 6 banks. And that's when it would be easier to introduce a central bank digital currency.
Well, we're already seeing the banks take strain. We've got unrealized losses at banks across the country rising to over $520 billion at the end of the first quarter of 2024. That's up from $478 billion at the end of the previous quarter of 2023. 50 banks saw unrealized losses on their investment security portfolios exceeding at least 50% of their capital equity in the first quarter of 2024. And that's according to the U.S. Bank's unrealized losses on investment securities screener. So we're already starting to see that. It's not getting a lot of attention. There's also a recent report by consulting firm Claros Group, which analyzed around 4,000 U.S. banks and found that 282 banks face the dual threat of commercial real estate loans and potential losses tied to higher interest rates. And the majority of those banks are smaller lenders with less than $10 billion in assets. So we're starting to see, again, problems in the banking sector. You're saying that at some point we're going to go from all of these banks to 6 to 8 big banks in the United States. Last time, I think you were predicting that could happen in as soon as a year. Give us an approximate, and again, I always give credit to people that come out here, make a forecast and put a timeline on it as well. But give us an approximate timeline as to when this could happen and how exactly this could play out.
Let me clarify. There won't be just 6 to 8 banks, but the majority of banking will be done with 6 to 8 banks. There'll be some banks left, but they won't have a lot of depositors. I expect this to, let's give it 12 to 24 months. And you got to remember, in the great financial crisis, this happened fast. A bunch of shotgun marriages happened overnight. Merrill Lynch disappeared. Lehman Brothers went poof. Bear Stearns went poof. And AIG essentially went bankrupt. This could happen fast, but I'd like to see it happen more slowly over 2 years with some sort of control. I know that sounds insane, but we don't want to live in a world where financial markets are crashing 50, 60% in a month. We just don't want to live in that world.
I don't think we want to live in a world, though, Ed, that only has 6 to 8 banks and the control that comes along with that. And as you say, that then ushers the way for a central bank digital currency to be put forward in a much more seamless way.
We don't want to live in that world either, but the more time we have not to panic, the more time we can mount a resistance. And you and I were on here a year ago, and look at all the awareness of central bank digital currencies as being something that people should be alarmed about. We have politicians introducing bills. So the good news is, the slower it goes, the resistance that we can mount to it, the faster it goes, people will panic into it, I think. So I'm actually quite pleased in the progress that was made over the last year. Candidates are highlighting the dangers of a central bank digital currency. So the issue is at least out there as opposed to where it was a year ago, where people were really not even talking about it as much as they are now.
Right. That is the upside, is that there's a lot more awareness about central bank digital currencies. And a reminder to our viewers, that is a form of fiat currency issued by a country's central bank, which essentially allows the bank to control every transaction, saying what transactions can and cannot happen. And it also creates complete transparency. There's no anonymity. There's no privacy. Every single transaction can be viewed. And then it also would arguably allow for what some say is fine-tuning of monetary policy, where they could just click away some of the money supply or click back in the money supply by just taking out some of the money in everybody's individual wallet to the central bank digital currency. A lot of potential negatives there. Why would fewer banks help facilitate that process?
It gives people less choice. Not every bank would be set up for central bank digital currency. It's just central planning requires fewer, bigger players. So it's easier to implement if there's a lot fewer players to impose this upon. So it's an operational thing. It's just easier to do.
Right. And as you were saying, look, we have had a lot more awareness about this, which is a positive. Certainly when people like former President Trump bring up a CBDC, it starts to gain headlines. And he actually addressed this very recently at the Bitcoin conference that just took place in Nashville. I think we have a soundbite from that. We can play that now.
Next, I will immediately order the Treasury Department and other federal agencies to cease and desist all steps necessary, because, there's a thing going on in your industry. They want to move the creation of a central bank digital currency. It's over. Forget it. CBDC. There will never be a CBDC while I'm president of the United States.
Does that give you any hope here? I mean, do you still think a CBDC is inevitable?
No, I don't. But what's great is the issue has gotten a lot of awareness. And Trump, just by saying that, it's fantastic. And Bobby Kennedy has said the same thing. And so we have candidates across the globe talking about the dangers of the CBDC, which is great.
They all seem to be Republicans, though. You've got Governor Ron DeSantis, Senator Ted Cruz, House Majority Whip Emmer, as we said, President Trump, and Kennedy, an independent. But I haven't heard anyone on the Democratic side speak against a CBDC.
Well, that's because they're control freaks, and they would love that tool to be able to implement all sorts of crazy control policies. They seem to have a belief system that if you don't agree with them, you're evil, and they want to impose any way they can their belief system on the general populace. That's my personal opinion. That's why Democrats will never be against a CBDC.
So does that mean that if we have a Democratic administration in power, that then increases the odds of a CBDC being passed, even though there's a motion and Powell has said it would need to go through Congress?
Yeah, the chances are higher. So I think voting Democrat this time is insanity at this point, given what we're seeing come out of Kamala Harris's mouth and her new VP pick, Tim Walz. They're both socialists. They both believe in DEI. They believe in taking from those who produce and giving it to those who don't. I mean, it's communism light.
All right. Well, back to CBDCs. There is progress happening in other parts of the world, regardless of what the U.S. is doing. We know that according to the Atlantic Council Central Bank Digital Currency Tracker, 134 countries representing 98% of global GDP are exploring a CBDC. In May of 2020, that number was only 35, so certainly a big acceleration there. And currently 68 countries are in advanced phases of exploration. 19 of the G20 countries are now reportedly in advanced stages of CBDC developments. We've also got a new report from the Bank of Canada suggesting that Canada's central bank sees digital currencies as necessary to maintain monetary sovereignty and financial stability as the use of cash declines. The bigger point here, Ed, is that if the rest of the world goes along with this, can the U.S. not? Can the U.S. be left out?
The U.S. is going to be probably where the resistance mounts from. So if we fail at this, then eventually it's a global slavery surveillance state. The CBDC is the linchpin of that digital ID. If everything you do is tracked, it's a disaster for the individual freedom. It's also a tool to implement crazy progressive policies. If people are worried about methane from cow farts, they could then institute, beef quotas, and you can't ring up your groceries at the register, because that's how deep this will go if they have this kind of control. So we have to oppose this at all costs. I mean, if we get close to this, you'll be hearing me talk more and more about it. But right now, I'm very hopeful it's not going to happen in the U.S. And if it doesn't happen in the U.S., the other countries will follow along eventually. Right.
The ultimate form of control, as you say, government can then monitor and track everything you do, from eating too much meat to taking too many flights, and then they can just program that currency to not work for those transactions. You don't even have a choice in the matter. Or it would work, but with a very excessive premium added to that transaction, disincentivizing people from doing it. It's terrifying. And we did see, I always like to point this out because it's so important to remember how we saw tremendous government overreach during the pandemic, during COVID, and an example, Canada, where the truckers who were protesting against the vaccine were essentially taken out of the financial system. Their bank accounts were frozen, and anybody that was donating to them had their bank accounts frozen. That required an emergency act, and it can still be done without a CBDC. But with a CBDC, it's just so much easier to do. Click of a button, and that's that. And that just the idea of that can deter people from voicing opinions that may be seen as cancelable in today's day and age. All right, but we're hopeful that a CBDC perhaps may be delayed with the increased awareness. You did say, though, that the way to bring out a CBDC is a crisis. And you did say that within 12 to 24 months, you do see a scenario where we have 6 to 8 banks left. So you do expect more collapses in the banking sector. What is your macro outlook then? How does this play out? And you can start off with the short-term outlook ahead of the elections, and then what you're seeing happening in the next 2 years.
Yeah, so short-term, again, this is the economy's, the way we measure it, started rolling over from close to the zero line, non-expansion, going back into recessionary levels in March. The structure of the market, and this is technical mumbo jumbo, but what we see from the structure of the market is a pullback into the election, anywhere from 10 to 30%. And that would be scary, but it's not a calamity. And then a rally after the election. And by the way, any kind of pullback into the election favors Trump. A rally after the election, and from that rally, there'll be continued economic data coming in that's bad. Then we think that's when the real potential for the collapse to begin would be sometime towards the end of this year, going into January. So that's our short-term, medium-term prediction, and from there we'll have to observe what happens. But that is going to be where we think it really starts to unravel, is in 2025. And if that occurs and we're right, and there's a crisis in 2025 financially, we'll see potential talk of a CBDC, because if you want to implement something, you do it in a crisis, and a UBI, because depending upon how bad the job layoffs are, there'll be a lot of people who are scared, and they might try to tie a UBI, universal basic income, to a CBDC. And that's how I would do it if I wanted to implement it.
So you're seeing a potential short-term pullback here, but ultimately, beginning of 2025, where do you see equity markets? And again, I get a lot of this depends on how the geopolitical situation plays out and who wins the U.S. elections.
Well, it depends on how quickly we unravel. So we think that the clock started last week. Economically, we're already going to go into a recession, but now we have financial plumbing problems that are now becoming apparent. So we get this correction into the election. The rally could last several months, but we may go back to close to the all-time highs. My guess is no, and then we roll over and fail. And that's when the real financial damage begins. And the Fed will be well into a rate cut cycle by then, if I'm correct.
So what do you think a gold does during this phase?
In a financial panic, there's usually a knee-jerk reaction to sell everything. So gold will have a pullback, but not like it did in the financial crisis in 2008. It had a 50% pullback. I'm seeing gold pull back maybe 25%, great buying opportunity. So gold long-term we're bullish on because whatever happens when it becomes apparent the economy is rolling over, we're having a global financial crisis, there'll be a policy response. And so we have to see what that policy response is and how effective it could be and how inflationary it's going to be. So we're in this roller coaster ride of deflation, then a monetary fiscal response that then is inflationary. So we're going to have this roller coaster of inflation, deflation going forward. Right now, we're in the beginnings of a deflationary period as the credit cycle starts to worsen. And so gold, I like long term. Obviously, if you're in the stock market, Warren Buffett has indicated what you should do. He's got his largest cash position ever in the history of Berkshire Hathaway. He owns 4% of the US T-bill market. Warren Buffett is not in cash for a 20% pullback. That's not what he does. He's in cash because he's going to take advantage of what happens when this unravels. And my guess is you don't hold that amount of cash if you're Warren unless you think a big financial crisis is coming. And an indication that we're close to the bottom would be when Warren Buffett starts issuing billions of dollars to banks to save them with very favorable terms to himself, like he did in the great financial crisis. He picked the bottom. So wait for Warren to start buying stuff, is my humble opinion on stocks.
The Oracle of Omaha, he does have a track record there. The Oracle of Omaha, not a big fan of Bitcoin. What are your thoughts on how Bitcoin could perform during all of this?
Well, Bitcoin, unfortunately, is correlated to liquidity. And in the liquidity crisis, Bitcoin will go down. But I think Bitcoin long-term should be part of everyone's portfolio. It's just a question of how much. I don't like putting all my eggs in one basket, but long-term, I'm bullish on Bitcoin. Long-term, I'm bullish on other cryptos, but they will not perform well they will not be a store of value in a financial panic. What's a real store of value is what Warren Buffett owns: 3-month, 6-month T-bills giving you 5.5%, paying you to wait. That's traditionally in financial panics, that's where everyone goes to in the short term.
And when the liquidity injections begin, when we start to see the rate cuts accelerate, what is your outlook on Bitcoin there? I know you said it's bullish for gold. Those that are for Bitcoin would argue that the same case could be made for Bitcoin, as the liquidity needs to be soaked up by a store of value, which may not do its job during a sell-off. But when you start to have the liquidity injected into the markets, what do you think that does for Bitcoin?
Right. So people got to remember, when the Fed starts cutting rates, it's not bullish. It's actually quite bearish. And the Fed doesn't want to cut rates because that means they're seeing something that's bad. And typically speaking, there's an 18-month lag on monetary policy. So if you remember the COVID war that we had in March, April of 2020, where the Fed went on a money printing spree in conjunction with government spending. The two are linked. You print money, the government spends it. So that created inflation that really didn't start taking off until 18 months later under Joe Biden. Concurrently, now we have the interest rate hikes, 18-month lag hitting in May. When the Fed does respond, there'll be an 18-month lag. That financial markets will move ahead of that, but the real liquidity will start impacting the economy 18 months later. Financial markets will anticipate that, but they'll be damaged first, then anticipation of the policy responses. But we have to see what the policy responses are, when they come, and how big.
And then again, back to the Bitcoin question, could that then be a positive?
Bitcoin will do well, absolutely. Bitcoin will take off in that scenario.
Ed, last time we spoke, you said that the dollar will fail up. Explain if that is still your position and what you mean by that.
Absolutely. The dollar has a 4-year cycle, the way that we measure it. My friend Tim Wood is a cycles analyst. The dollar hit a high several years ago, and it's going to hit a 4-year cycle low sometime next year. But if you look at the long-term chart of the dollar, since the great financial crisis, it's been higher highs and higher lows. We expect the low in the dollar to be higher than the last 4-year cycle low. And if that's the case, the next run up in the dollar will take us to new all-time highs. So as the global financial system contracts, it's long-term bullish on the dollar. And if the dollar ever needs to get unwound as the reserve currency of the world, it'll fail up. Right now, these BRICS are talking big about de-dollarization. The problem is if you de-dollarize overnight, you will have a deflationary depression in your country. So that's why long-term I'm bullish on the dollar, because the dollar is a debt-based fiat world reserve currency. It goes up when credit is long-term contracting, and the growth of the dollar has kind of reached its peak. So when you see the dollar going down, that's liquidity being injected in the system. The money supply growth is going. When you see the dollar going up, that's contraction. Long term, under a de-dollarization scenario, the dollar will go up.
But you're saying long term, you're bullish on the dollar, and at the same time discussing de-dollarization. So what do you mean by that exactly?
What I mean is the way the dollar system was perpetrated, it was flooded into the global financial system. There's over 14 trillion in US dollar denominated debt held by foreigners. So to extinguish that debt, you're going to need dollars to do it. So the dollar fails up. It doesn't fail down. That's one of the misnomers.
So the dollar relative to other currencies will appreciate in value, is what you're saying. But
yes.
Ultimately, it'll lose its place as king of the reserve currencies, if I'm understanding you correctly.
Correct. And at some point, and if we ever get into, if we don't take care of this deficit problem, right now I'm not worried about the deficit in terms of it, becoming a credit issue for the U.S. because there's other countries that are way worse, like Japan, 260% debt to GDP. We have 120% debt to GDP. So relative to Japan, we're a better shirt. So that's why I still think the dollar fails up over time. I know it's confusing. And mind you, if Trump gets in, Trump is going to be a weak dollar president. Trump wants the value of the dollar to go down as he tries to implement some of his policies of bringing manufacturing back to the U.S. So Trump is a weak dollar president.
A weak dollar president, what does that mean for inflation?
It depends on how it's configured. It could be both inflationary or not, depending upon what happens. But I think it'll be inflationary because as he brings back manufacturing jobs to the U.S., it'll definitely be inflationary. But people have jobs, so there's this, and it depends on the rate of inflation. Inflation isn't necessarily bad if it's slow. Inflation is super bad when it's fast.
Right. I mean, weaker dollar means more manufacturing happening in the U.S., allows U.S. exports to compete on the world stage and makes the U.S. more independent in terms of manufacturing, bringing back all of that back home. But then you don't get the advantage of buying cheap goods made in China.
Correct.
Hence inflation, but arguably more job creation there. Let's get your outlook.
One of the biggest problems we have in this country is we have a bifurcated economy. We have the very rich doing well and the very low income people doing well via handouts. We have a devastation of the middle class, which is the backbone of the U.S. economy. The middle class is getting wrecked. So politically, this is what we're seeing. And so we need to fix the middle class or this country's done. That's just the bottom line.
Ed, the whole global debt crisis, markets are going to sell off. We've hit the end of the road. That conversation has been had since after the 2008 crisis a few times, saying that the Fed's response is going to lead to this major, bigger, chaotic mess. And yet every time we think that it's the end of the road, somehow that can gets kicked down further. Why are you so sure that this really is the end of the road, be it in a year's time, 2 years' time, even 3 years' time? What makes you so sure that this really is the end of the road?
So the question is, can they kick the can down the road one more time? I won't know until I see the policy responses. But what I can tell you with great confidence is we're going to have financial havoc and turmoil coming soon. What I can't tell you is if they can kick the can down the road one more time. But if you look at ever since the great financial crisis, the government deficit or the actual just debt load of the government has been floating along the global debt system. And since the great financial crisis, they've had to not only grow the debt constantly, but they've had to accelerate it at certain times at even faster rates of growth. They had to do it during 2014-15 when there was a problem with China. The Shanghai Accord fixed that. Then we had the 2019 global financial crisis that was starting to bubble. They fixed that with the COVID war. And so the time frame between crises is getting shorter, and we need to keep accelerating the debt growth even faster. So that's why it's getting very precarious. Every time they do something, it buys less time to fix the system. That's why it may not be this time, maybe the next time, but we're close, and it's within our lifetime, unfortunately.
Let's go back to what you said about if Trump wins the election, he wants a weaker dollar to onshore manufacturing, make America great again by building things back in America. what happens if the Democratic Party wins the election? What do you think happens then?
I think it's this crazy spend and control economy with surveillance state and a purging of anybody that isn't in the Democratic mind camp.
A purging of everybody that isn't in the Democratic mind camp. Is that what you said there?
I don't mean they're going to go to camps. I mean, it's going to be harder and harder to get jobs. A lot of the jobs are going to be government jobs. So you'll have to be a Democrat. That you have to, toe the line. It's going to be very hard for people in the private economy to compete with the government spending, because the government will become the economy under Harris and Waltz. Government spending as a percent of GDP got around to 24% during COVID. It's backed off a bit, but I continue to see government spending swallowing private spending.
So if you were to give us your forecast, how do you see the election playing out? And again, so many things can still happen, so many unvariables, but what do you think is the most likely scenario here?
This is pure speculation on my part, but I see this market correction favoring Trump. I see Trump getting in. It'll be very hotly contested. I think the oligarchs are nervous about playing with the communists, because ultimately the communists will come for them. So I think there's been kind of a shift in attitude with a lot of people who are against Trump running to Trump now. I think the establishment, there's a certain segment of the establishment that wants Trump in there. They've had enough of this disaster scenario we've seen with immigration, the mishandling of the economy, the lying about the economy. So I think Trump wins. They'll try to steal it, but I think ultimately gets in, but it'll be very hotly contested, and the country will be very divided after the election, regardless of what happens.
And he will then have a recession to look forward to in 2025.
Correct.
So, Ed, how are you positioning your portfolio in this climate?
Well, I don't like to give investment advice, but I've been telling people, do what Warren Buffett does with a certain portion of your assets so that you can take advantage of the sell-off when it comes. It's called dry powder. So have some dry powder, sit back, earn 5.5%, and then when Warren Buffett starts getting in the markets, you start nibbling.
Watch what the Oracle of Omaha does. As we wrap up here, Ed, where can our viewers learn more about you?
FinanceTechnologies.com, spelled with a PH. Also on Twitter at Dowd Edward, D-O-W-D Edward, and Getter at Edward Dowd.
Well, Ed, thank you for coming on, and thank you for giving us your insight, your forecasts with a timeline. That's always a bold move. We appreciate you doing that, and we appreciate your time and your analysis. We look forward to having you back on soon, Ed Dowd.
Thank you so much, Michelle. Great to be here again.
And thanks to our viewers, as always, for watching. And a big thanks to our sponsor, Swan Bitcoin. I want to highlight that Swan does have an IRA product where you can take advantage of the benefits of Bitcoin's long-term potential in a tax-advantaged account. With a Swan IRA, you're holding real Bitcoin, not proxies. And opening a new Swan Bitcoin IRA is, in fact, very simple. You can initiate a transfer or a rollover and then hold real Bitcoin in your new IRA. There's a way to set it up so that you're basically buying Bitcoin on autopilot. That then allows you to take advantage of those Bitcoin price moves and of dollar cost averaging as you accumulate Bitcoin into your IRA. And unlike when you trade Bitcoin outside of a tax-advantaged account, doing so within an IRA allows you to avoid the often very tedious process of reporting trades on your taxes every year. So if you're interested, there's a link in the description with a special offer for Kitco viewers to help facilitate that process. Check that out. And as always, thank you for checking us out. If you're watching us on YouTube, make sure to subscribe and leave your comments. Feel free to praise, whine, or just opine. We do like to hear from you. For me, Michelle Makori, and the rest of the Kitco team, we'll see you again soon.
On the Spot with Michelle Makori is brought to you by Swan Bitcoin. Swan Bitcoin IRA. Your legacy, your way. Real Bitcoin, not proxies. traditional and Roth IRAs. Fast, easy setup. Start now at swan.com/retire.